What requirements a company must have when conducting an audit?
The first requirement is the financial statements. A company needs to produce a financial statements, and those statements cannot be done by the auditors. Otherwise, independence will be compromised. That is the first requirement for an auditor to produce a report is independence. So without independence, the auditor cannot provide an audit report. So the first requirement is a set of financial statements, balance sheet, profit and loss, and cash flow, a set of financial statements to provide those financial statements to the auditors. That is the first requirement. Second requirement is the provision of a management letter. Management letter is the one that I said before, is the affirmation of the responsibility of management, that all transactions have responsibility of management. That is the affirmation that management does and signs. This could be a CEO or the president of the company that is signing. Also, the attorney needs to provide a letter confirming that this I said before, the attorney needs to provide a letter that there is no legal lawsuits that will compromise the ability of the company to function in the future. Once all these elements are given, all these papers or these documents are given, is when the auditor is able to provide with the examination. Within the examination, there is questionnaires. There is a list of questions that the auditors give as the audit process goes. If there is, for example, accounts receivable that need to be confirmed, the auditor also needs to send independent confirmations. For the banks, the auditors need to confirm the bank directly with the banks. Before it used to be letters. Now, in the USA, there is a system to verify, well, perhaps not immediately, but you do it online. You can do the verification of the bank balances with the banks, not with the client anymore. Before, in the past, the auditor has a format for a letter. Sign the letter and give it to the client, for the client give it to the bank, because the auditor doesn't have a relationship with the bank. But that in many cases, those are cases for books. Fraud was committed, and then accounts and balances were forged, the reports. So in the US, it's saying 2000, like quite a few years ago, was implemented the ability to verify bank balances directly with the bank. So only you enter to that application, then the client needs to verify that you are the auditor of the company, and then once the client verifies, then the bank sends directly in the system, in the online, sends directly the verification of the balances. So there is no need to, in the future, to verify. So this goes with the verification of the financial statement before the production of the report. Then goes the verification with the vendors, if there are accounts payable. If we are dealing with banks, for example, then that will be verification with specific clients. If there are loans, for example, then loans verified with specific clients as well. So it's a process of verification, and verification for balances, receivables and credit and payable, and also verification of the actual balances of the account, the transactions. So once all these elements are covered, then it comes the draft report, and that draft report is the one step before the actual report. So all these requirements, there are formal requirements are in the financial statement. There are management requirements like the letter from the management confirming the responsibility for the financial statements. There is a letter from the attorneys confirming that there is no legal lawsuits for that creates a danger for the company working in the future, where it's called ongoing concern. And then comes the verification of the banking of the balances of the bank, that is directly with the banks. Verification of the account payables and account receivable. verification of investment, verification of loans, verification of balances, investment, for example, investment in the stock market, investment in bonds, investments in general. And then at the end, it comes the report with all the recommendations and the explanations that are required. But those are the requirements that a company will need to comply for let's say for obtaining for an auditor to provide the audit report at the end of the year. This also requires physical verification. For example, when there is fixed assets need to be be verified physically, and review what is the classification of the entity for the administration of the fixed asset. If there is any lease, if there is any kind of management system that the entity will provide for the review and the organization of the fixed asset. If not, then the auditor will review the transactions and the purchases of a fixed assets with the physical assets that are required. This involves many times visiting several offices. If the company has several offices, or going to the physical places where the assets are located. We think of assets like computers, machines, but what about, for example, turbines, like large steel plants where assets are in the hundreds of millions of dollars, probably in the billions of dollars? What about like the eolic turbines, for example, like those large fixed assets that create energy? What about there are, for example, utilities, all the utilities, the ones that provide electricity, power, the ones that provide water, pipelines? All those are fixed asset, large fixed asset investments that require an exhaustive and very well knowledge of the valuation of the existence of those large investment assets.